चलिए दोस्तों, फिनेंशियल फ्रीडम एट स्टॉक मार्केट के एक नए वीडियो में आप सबका स्वागत है। आज हम बात करेंगे कि एक लर्निंग वीडियो का सीरीज स्टार्ट करने जा रहे हैं जिसमें जिसमें हम स्टॉक मार्केट बेसिक्स से लेकर फंडामेंटल एनालिसिस, फ्यूचर ट्रेडिंग, करेंसी, कमोडिटी एंड गवर्नमेंट सिक्योरिटीज, तो चलिए शुरुआत करते हैं। तो स्टॉक मार्केट बेसिक का पहला बिगिनर से हम अगर स्टार्ट करेंगे तो आपका पहला आएगा एसेट एलोकेशन। इसके बारे में डिटेल में हम जाएंगे तो समझेंगे कि यहाँ पे लिखा हुआ है, योर इन्वेस्टमेंट शुड हैव ए स्ट्रॉन्ग मिक्स ऑफ ऑल एसेट क्लासेस. इट इज prudent to diversify your investment among the various assets to create an investment portfolio. The technique of allocating money across assets is referred to as asset allocation. For instance, a young professional can take a higher amount of risk given in his age and the number of years to retirement. Typically, such investors should allocate at least 70% of investable amount in equity, 20% in fixed income, and the rest in gold or silver. By the same logic, a retired person could invest 70% of his saving in fixed income, 20% in equity market, and 10% in precious metals like gold, silver, etc. As you can imagine, the ratio in which one allocates investments across assets it depends on the risk appetite of the investors. Second point है ecosystem. From the previous set of cards, we conclude the equities as an asset has the potential to generate high returns. Hence, it is prudent to include equities in the investment portfolio. Having said that, how do you go about investing in equities? Clearly, before we dwell further into this topic, it is extremely important to understand the ecosystem in which equities function. Just like the way we go to the neighborhood supermarket to shop for our daily needs, we go to the stock market to shop, read as transact for the equity investment. Transact is simple terms means buying and selling. The main purpose of stock market is to help you facilitate equities transactions. So, if you are a buyer of a share, the stock market helps you meet the seller and vice versa. Now, unlike a supermarket, the stock market does not exist in a physical form, it exists in electronic form. You access the market electronically from your computer and carry out your transactions, buying and selling of shares. There are two main stock exchanges in India, Bombay Stock Exchange, namely BSE, and the National Stock Exchange NSE. Now we have to know market participants. Anyone who transacts in the stock market is called a market participant. Market participant can be individual or corporates. They can be classified into various categories such as domestic retail participants. These are people who like you and me transact in market. NRI and OCI. These are people in India origin but based outside India. Domestic institutions. These are large corporate entities based in India. LIC of India is a classic example. Asset management companies AMC. These are mutual fund companies such as SBI Mutual Fund, DSB, HDFC, AMC, Franklin, etc. Foreign institutional investors, non-Indian corporate entities. These could be foreign asset management companies, huge funds, and other investors. Now, irrespective of the categories of market participants, the agenda for everyone is the same: to make profitable transactions more fluently put to the market money, to make money. So, next, we can understand why regulate. Regulate where money is involved, human emotions in the form of greed and fear run high. One can easily fall prey to these emotions and get involved in unfair practice. In India has its fair share of such twisted practice thanks to Harshad Mehta and the like. Given this, the stock markets need someone who can set the regulation rules of the game and force market participants to stick to these rules, thus making the stock markets a level playing field for everyone involved. These rules are set by the regulators of the industry and the rules are called the regulations. Now we have to know the financial regulator and intermediaries. These called SEBI. The Indian stock market regulator is called the Securities and Exchange Board of India, often referred to as SEBI. The objective of SEBI is to promote the development of stock exchange, protect the invest of retail investors, and regulate the activities of stock market participants and financial intermediate intermediaries in general. SEBI ensure the stock exchange, BSE and NSE conduct its business fairly. Stockbrokers and sub-brokers conduct their business fairly. Participants don't get involved in unfair practice. Corporates don't use the markets to unduly benefit themselves. Large investors with huge cash piles should not manipulate the market. The overall development of market. Given the above objectives, it becomes imperative for SEBI to enforce regulations across all the entities involved in the market. Let's take a quick look at these entities operating in market and their role in market ecosystem. So, let us conclude today because the video is going to be long and we are going to start the series as I said earlier. So, we may continue tomorrow. Thanks for watching.